The US is once again approaching the debt ceiling, and Republicans and Democrats are playing an intense game of chicken. You might be thinking, debt ceiling? Sounds like a boring home renovation project. But trust me, this is one renovation that could potentially tear down the house. Here's a quick explainer for those who aren't familiar with the debt ceiling. It's basically a limit on how much the government can borrow to pay for its obligations. When we hit the ceiling, it's time for Congress to make a decision, raise the limit or face default. This time, though, it's like watching two stubborn toddlers refusing to share their toys. If both parties don't cooperate, the US could default for the first time in history. But wait, there's more. The plot thickens as we delve into the history of the debt ceiling. Believe it or not, this showdown has been happening since 1917 when the debt ceiling was first introduced. Back then, it was a response to the need for more financial flexibility during World War I. Little did they know that it would turn into a recurring game of political brinkmanship. So, what's changed since then? Well, the stakes have gotten higher, the numbers bigger, and the consequences direr. And that brings us to the current situation, with both parties at loggerheads over raising the debt ceiling yet again. The big question is, how bad would a default be? Well, let's hop into our time machine and go back to 2011 when the government came dangerously close to defaulting. That little crisis reportedly cost a cool $1 billion in lost economic activity. Awkward laugh, but hey, who needs a functioning government, am I right? This time around, it could be even worse. Think Great Recession 2.0, but with the government unable to cushion the blow. Now that's what I call a sequel no one asked for. But let's not forget the global ramifications of a US default. As the world's largest economy and issuer of the world's reserve currency, the fallout would be felt far beyond the borders of the United States. Global financial markets could go into a tailspin, and the ripple effect would likely hit economies around the world. Other nations holding U.S. Treasury bonds would suddenly face uncertainty, potentially leading to a massive sell-off and a further decline in the value of the U.S. dollar. So yeah, not exactly the kind of global party we want to host. The US dollar has long been considered the world's reserve currency, meaning other countries stash away greenbacks as a reliable store of value. With that status comes immense power and influence. But with great power comes great responsibility, and the US defaulting on its debt could seriously threaten its position as the global economic leader. In the aftermath of a default, other countries might turn to alternative reserve currencies like the euro or the Chinese yuan, further destabilizing the US dollar and its influence. You might be thinking, well, I'm not the government, so why should I care? Great question, average Joe. While it's hard to quantify the exact impact, let's just say it wouldn't be pretty for our wallets. In a world where the US dollar is the go-to stable investment, a default could send shockwaves through the global economy, impacting jobs, retirement accounts, and interest rates. Speaking of interest rates, the Federal Reserve has recently increased them to tackle inflation levels that have gone rogue. They've jumped above the 2% target like a caffeinated squirrel. Higher interest rates mean more expensive borrowing, which could put a damper on economic growth. So yeah, definitely not a party anyone wants to be at. Now, let's put on our thinking caps and dive into some economic theories that could help us understand the debt crisis. There's the Keynesian approach, which advocates for government spending during economic downturns to stimulate growth. On the other side, we have the Austrian school of thought, which favors free market solutions and minimal government intervention. In reality, most governments, including the US, employ a mix of these theories, but the ongoing debate fuels the political divide over issues like the debt ceiling. So, what can we do to avoid this financial Armageddon? Well, for starters, both parties could cooperate to find a responsible way to manage the national debt, such as a combination of spending cuts and revenue increases. Easier said than done, of course. Another idea is to reform or even abolish the debt ceiling altogether. Some argue that this self-imposed constraint does more harm than good, and that scrapping it could prevent future political standoffs. Alright, time for the twist. Here's a mind-bending question for you. What if the debt ceiling is a self-imposed constraint that makes the entire crisis kind of unnecessary? You see, unlike you or me, the US government creates its own currency. In a way, it's like a teenager with an unlimited allowance, except without the angst and acme. So why not just print more money and avoid the drama? Well, while it's technically possible, it's not that simple. Printing money can lead to inflation. Just ask Zimbabwe or Venezuela. Now for the thought provoker. How do you think we can navigate this delicate balance between controlling inflation and avoiding default? And finally, the call to action. Want to know more about the fascinating world of debt and economic policy? Subscribe to our channel, like this video, and share your thoughts in the comments below. And remember, econ nerds, knowledge is power, especially when it comes to understanding the roller coaster that is the US debt crisis. Buckle up and stay informed.